Part 8. The difference between investing and trading. There is one key difference between investing and trading. Investors buy and hold stocks based on a company's performance, while traders can profit from both rising and falling markets by using short sell positions and systematic trading systems that take advantage of both sides of the market. Investing and trading are two distinct approaches to participating in the financial markets. As an investor, you would put your money into the stock of a company at its current value. Your profit or loss would depend on the performance of that company. If the value of the company's stock increases, your investment will also appreciate at the ratio corresponding to the amount you invested. Conversely, if the company's stock value decreases, you would experience losses. On the other hand, trading, specifically high-frequency trading, offers the opportunity to make money in both rising and falling markets. This is achieved by taking short sell positions, where traders bet that the market will go down, allowing them to profit from the difference between the open and closing prices. High-frequency trading opens the door to an array of infinite trading strategies that can be created to profit from the market in a balanced and systematic approach, utilizing both sides of the market. This enables traders to build a large trading business with automated trading systems, while investing remains focused on the performance of a company and is entirely dependent on markets rising. This is what makes the trading aspect of the financial markets much more lucrative and larger in size.